Good afternoon and welcome back to the Smarter Wealth channel. I am your host, Troy Lerche, bringing you this week in wealth. I wanted to say I hope everybody had a great weekend and enjoyed the first NFL preseason games. As you can see, I have the great Mile High city of Denver and their stadium. That's where I'm a big fan of the Broncos, but I am rooting for the hometown Jaguars here in Northeast Florida. I also wanted to ask everyone, if you like our content, to click the like button. And if you want to make sure you don't miss any content, make sure you hit the subscribe button down below. We really would appreciate it, and it helps us understand who's watching. Without further ado, let's jump right into the week in wealth. Last week, we had the CAPE indicator, which was up even higher to 38.81 from 38.54 last week. We remain in cyclical bull territory, and 4 of our 4 indicators are still green, which means that new cash and current cash should be deployed unless there's a reason like a cash restriction or withdrawal, an upcoming withdrawal or monthly withdrawals that we help set up for clients. Last week, U.S. markets were mixed, but the headline indices continue to gain ground as the market mostly shrugged off the concerns about the spread of the Delta variant of the coronavirus. Within these benchmarks, the S&P 500, within the benchmark S&P 500, the value stocks outperformed growth counterparts. The Dow Jones Industrial Average finished up 307 points for a gain of just under 1%. The NASDAQ actually ended down 0.1%. And by market cap, we had large caps adding 0.7%, mid caps gaining 0.5%, and the small caps retreating 1.1%. So that's a significant difference. As you have seen probably in the past, small caps can lead the way up as well as lead the way down sometimes. In international markets, we noticed that international developed markets added 1.4%, while emerging markets pulled back 0.4%. In commodities, we had precious metals finish the week mixed, with gold rising just under 1% to $1,778 per ounce, while silver actually retreated 2.3%. Crude oil was essentially flat for the week after last week's decline, and the industrial metal copper finished the week up 1%. In U.S. economic news, it's lots been talked about with the job market, and it's truly a job seekers market. The number of job openings in the U.S. rose to a record 10.1 million in June, the Labor Department reported, which is the 4th consecutive all-time high. Economists had expected job openings to rise 9.3 million, so that's a pretty substantial jump. The data is proof labor market is firming and businesses continue to seek workers. Also, one thing to note in the report was the first time in 6 months that the rate of hiring actually outpaced the rate of job openings. There was optimism among the nation's small business owners, or actually optimism amongst small business owners actually retreated in July after hitting the highest level since the November election last year. The survey found business owners are losing confidence in the strength of the economy and expect a slowing down in job creation. Prices at the wholesale level surged again, rising sharply in July for the 6th month in a row, offering no evidence that the increased inflation is near its crest. The Bureau of Labor Statistics reported that the PPI, or Producer Price Index, jumped a whopping 1% last month. Economists had only forecasted a 0.6% advance. In the report, most of the increase was concentrated with services such as airline tickets and hotel rooms amidst the surge in travel this summer. Wholesale auto prices have also sharply risen due to the demand, and because car makers are unable to maintain production levels, shortage with key components, which you've heard in many of our other videos, the chip shortage. The pace of wholesale inflation over the past 12 months moved up to 7.8%. From 7.3%. That's the highest level since the index was reconfigured in 2010, and likely one of the highest readings since the early 1980s. In Asia, China's worst coronavirus outbreak in a year, as authorities taken drastic measures to limit its spread. While locking down cities, canceling flights, and suspending trade may bring the virus back under control, those actions risk stalling a precarious recovery. While the numbers of cases remain small by comparison with recent surges in infections in the United States and Europe, China has aggressively revived its quote unquote, zero COVID strategy. Those drastic moves have already prompted some economists to slash their growth projections for the world's second largest economy. Goldman Sachs analyst forecast China's GDP to grow by just 2.3% in the third quarter from the previous quarter, which is dramatically lower than the 5.8% increase than they originally expected. And finally, Jimmy Dugan, the manager of the Rockford Peaches, played by Tom Hanks in the famous movie A League of Their Own, he said that there's no crying in baseball. It seems though, however, there's a lot of crying in investing, at least for some generational age brackets. A survey of more than 1,100 individual investors by Magnify Money revealed that investors generally, and Gen Z investors in particular, have experienced regrets over the impulsive investing decisions. They've lost sleep over their investments, have invested while drunk, and have defied Jimmy Duncan's words by crying about it. Boomers were found to have much less prone to these behaviors than the other age cohorts, but even boomers have some regrets. So again, we want to thank everyone who's watching these videos. Make sure you go ahead and hit the like button. And if you want to make sure you don't miss anything, you can subscribe to the Camarda Wealth channel. Hope everyone has a great week and stay safe out there. And we'll talk to you soon. Take care.